What is win rate? What is risk to reward? How do you compute for them, and why do you need them? Why do we need to manage risk? This table shows you the percentage of losses and the percentage of gains that you need in order to break even on these losses. If you lose 5% on your trade, you have to gain 5.28% to gain back what you lost. The percentage is higher because after you lose from a previous trade, your capital that is left in your portfolio that you will use for the next trade will be much lower. This capital in your portfolio would have been reduced by 5%. So for example, you traded $100. You lose 5% on that, so you're left with $95. You have to gain 5.28% on that $95 in order to break even on the previous loss of 5%. If you lost 10% on the previous trade, you have to gain 11% on the next trade in order to break even. So as your losses accumulate, you'll find that it is very, very hard to regain back your losses. For example, if you lose 50% of your portfolio in a single trade, you will have to double your money in order to gain back your losses. You have to gain 100% on the next trade. The market has been around for a long, long time and will continue to be there even after you've lost all your capital. So you need to manage your risk to ensure that you will be there for the long haul. Let's talk about risk to reward ratio. The risk to reward ratio compares the risk or the amount that you stand to lose versus the reward, the amount you stand to gain from the trade. The risk to reward ratio helps you assess the trade. Is the risk involved in the trade worth the reward? This table shows how you can compute for the risk to reward ratio. For example, you have an entry price of $10, your target price is $15, and you want to stop your losses at $9. Your risk, which is the entry price minus the stop loss point, is $1. Your reward is the target price less the entry price, which is $5. This means that for every $1 of risk, the reward is $5. Deciding where to enter a trade, where to stop losses, and where to take profits depends on your trading strategy. You could be a breakout trader, or you can be a range trader. The trading strategy that you use will determine where to enter and exit a position. This also determines what your stop loss point is. In this example, we find a bullish trade setup in an ascending triangle pattern. Price made a bullish reversal candlestick as the long bearish candlestick was followed by a long bullish reversal candlestick. The bottom made the second low within the ascending triangle pattern. Due to the bullishness created by these patterns, we could compute for the RRR in the case of a breakout above the ascending triangle at 70.30. So this was the high of the previous candlestick. We measure the target price of the ascending triangle at approximately 20. We also draw the Fibonacci extension using the trend-based Fibonacci tool. This shows two Fibonacci resistances, 1.382 at 1920 and 1.618 at 1999. There's a confluence between the pattern target at the 1.618 Fibonacci, making this a very strong resistance. So to be conservative, we will use resistance 1 as our target price. Although price may very well break above that, using the first resistance as your target will ensure that any failure to break that resistance area would still give the trader a good RRR. In this trade, the risk is computed as 0.5 while the reward is 185. The RRR is at 1:3.7, rounded off as 1:4. Based on the RRR, this is a very good trade to take because the rewards far outweigh the risks. Now, when deciding to trade at breakout, the basic assumption is that the market is strong enough to break the strong resistances and follow through on the breakout. However, when trading on a bounce trade, we assume the opposite. So this is an example of a chart where we will compute for the RRR based on a bounce trade at retracement levels. In this example, the price made a bounce from A and then a bearish candlestick was formed at the resistance point B. We draw the Fibonacci levels from A to B to find out where the price could bounce. At the 618 Fibonacci level, a bullish candlestick was formed. This also formed the bottom of the ascending triangle pattern. We compute for the RRR when entering this level to find out if the trade is worth our time. The RRR for this trade is at 1:6, so this is an even better trade than the breakout trade. This shows you that chasing prices on a breakout is not always the most profitable trading strategy. What is the win rate? The win rate pertains to your batting average or your hit rate. So for example, you have 10 trades, and out of those 10 trades, you are right 3 times, but you are wrong 7 times, then your win rate is at 30%. If you are right 4 times, and then you are wrong 6 times, then your win rate is at 40%. The best traders are only right 50% of the time. With this win rate, how do traders make money? You should know that even if you have a low win rate, you could still make money off the market by properly employing the risk to reward ratio with respect to your win rate. This table shows the net gain or the net loss, assuming a win rate of 30%. So in order to simplify the table, we did not compound the wins and the losses. So let's say you have a fixed win rate of 30% across your trades. Now, how much money would you earn at various RRR? Gains and losses, assuming risk to reward ratios from 1:1 until 1:5 were computed. So assuming you had a capital of $10 and a win rate of 30%, this means that you are right 3 times out of 10 trades and wrong 7 out of the 10 times. If you use a risk to reward ratio of 1:1 in your trade, while your win rate is only 30%, you will incur a net loss of $4 after 10 trades. So that's a 40% drawdown on your portfolio after 10 trades. Now, if you used a RRR of 1:2, your net loss is at $1. However, if you used a 1:3 RRR, while your win rate is 30%, you would have gained $2 after 10 trades. So that's a 20% gain, and it's not bad at all, considering that your win rate is not really very high at 30%. So this tells you that you should not take trades with RRR less than 1:3. Because if your RRR is at 1:2, you lose $1. If it's 1:1, you lose $4. At 1:3, and the win rate of 30%, this is your tipping point. You end up with a gain rather than a loss if you limit your RRR to nothing lower than 1:3. So if you choose a trade that has an RRR of 1:4 and your win rate is 30%, after 10 trades, you would have gained $5. And at the RRR of 1:5, the net gain is $8 after 10 trades. So that's a whopping 80% gain. So the shift in fortunes occurs at the 1:3 RRR. So this is the likely reason why traders use this as their minimum RRR for any trade. Especially considering that a 30% win rate is an acceptable win rate. Now let's look into this next chart. This chart computes for the net gain or loss at the various win rates with a fixed RRR. The purpose of this table is to find out what the minimum win rate should be with an RRR of 1:3. From the table, the capital is fixed at $10. At a win rate of 10%, meaning that the trader is right 1 out of 10 times and wrong 9 out of 10 times, and employing the 1:3 RRR, the net loss is at $6. So that's a 60% loss. At a win rate of 20%, at a 1:3 RRR, the net loss is at $2. Now, at a 30% win rate, there is a $2 gain. At a 50% win rate with an RRR of 1:3, the gain is at $10. So that's a 100% gain. So these two tables show us the importance of combining the win rate with the RRR. A trader who has a win rate of 40% or higher will be able to enter trades with RRR of at 1:2 and still come out with a profit. A trader with a win rate of 30% must only enter trades with an RRR of 1:3 or better in order to stand to gain. So this knowledge allows you to filter your trades according to your win rate and to plan your trade accordingly. So if you have a low win rate, ensure that based on the RRR, you will still end up with a gain. You can easily compute this by entering the entry and exit prices, your stop loss prices, and then compute for the net win or loss based on the win rate and the RRR. In summary, the risk to reward ratio should be used with the win rate to determine whether a trade is right for you.